of IMAP webinars on global interest rates and the implications for fixed interest investing. In the first two sessions, we've looked at the macro trends of rates and the implications for mainstream, government bonds and private credit. Today, we're fortunate to be joined by two portfolio managers, and we'll be talking about the way they think about fixed interest investing in the context of the overall portfolio. It'll be my pleasure in a moment to hand over to Khurram from JANA and to have him introduce our presenters. But before I do hand over, let me just share with you a couple of upcoming events for us. Advice in Action in July is our opportunity to consider the issues around advice and advice practices with a reference to managed accounts. But this year we'll be focusing particularly on high net worth clients and providing advice and portfolio management services to that segment of the market. In September, we'll be taking part in Sydney Alternatives Week with a session called Alternatives in Discretionary Portfolio Management, SMAs and MDAs. And we'll be looking at how alternatives can play a part in the management of portfolios through a managed account structure, either SMAs or MDAs. Then in October, our Independent Thought conference, where we showcase portfolio managers. And a new thing for us this year is the MDA symposium in November. This year, as many of you will know, ASIC are reissuing the MDA instrument. And so as part of that, and partly to deepen our service to MDA providers, we're going to be running a set of workshops on responsible manager masterclass, best practice advice in MDAs and risk management processes for MDAs, and a week of webinars focused on individual MDA topics, leading up to the symposium in November, following the release of the instrument in October by ASIC. So if MDAs are part of your advice process, we'd welcome you joining us for those, and we'll be advising more about that shortly. Of course, this is the time to enter the awards as well. So if this is something you're thinking about, and I know one of our panelists today, in fact, several of our panelists today, prior entrance to the IMAP Managed Account Awards process. We encourage you, of course, to ask questions through the Q&A button on your screen. So now it's my pleasure to hand over to Khurram from JANA Investment Advisors to host our session today on fixed interest investing with a portfolio management context. So Khurram, thanks very much.
Thank you, Toby. Good afternoon. Hi, everyone, and thanks for joining today. Welcome to the third and final session of the webinar series titled Global Interest Rates and the Implications of Fixed Interest Investing. Today's session is titled Portfolio Construction in the Current Environment, with a focus on diversification across strategies and inflation protection. My name is Khurram. I'm a senior consultant at JANA, working with several wealth and superannuation clients on portfolio construction, manager selection, and governance. I will be moderating the session today. Just to set expectations for the session, I'll spend a few minutes framing the topic. Then each speaker will share a short perspective, followed by a Q&A session. On Monday in session one, we spoke about the more complicated macro backdrop with inflation risks that can reappear, central banks that aren't moving in lockstep, and a rates outlook that's uncertain. In session two yesterday, we looked at how income opportunities have broadened beyond traditional bonds, including private credit and alternatives, but with more complexity around liquidity, valuations, and manager selection. Today, we shift from markets to decisions. How portfolios are being constructed in practice, particularly on the defensive side and within fixed income. Many portfolios were built in a world of low inflation and falling rates, where diversification relationships were fairly reliable. More recently, inflation has been more volatile, rates have moved up sharply, and correlations have not behaved the way people expected. So the big question is, how do you build a portfolio that still holds together when the old playbook doesn't? There are three big challenges we'll focus on today. Firstly, how to achieve diversification at a time when correlations are less reliable. Secondly, how to find the balance between income, liquidity, and risk across public and private markets. Investors want resilient income, but they also want the flexibility when conditions change, and that trade-off has been front and center. Finally, how do we protect against inflation? Inflation protection is a portfolio design choice. Some tools are direct, like inflation-linked bonds. Others are more indirect, like real assets or companies with pricing power. And each come with their trade-offs. With that backdrop, let me introduce our speakers. First, we'll hear from Chamath Silva, Head of Fixed Income at Betashares. Chamath will cover the global rates backdrop, how bond diversification has behaved across different regimes, and what that means for the role of fixed rate bonds in portfolios today. Then we'll hear from Tristan Bowman, partner at Cameron Harrison. Tristan will focus on the more volatile inflation-driven backdrop and what that means for fixed income positioning, particularly the importance of actively managing interest rate and credit exposure. With that, I will hand it over to Chamath. Over to you.
Great. Thank you, Khurram, and thanks also, Toby. I might start off with, I guess, my current position, and that's that the death of the 60/40 or reports of the death of the 60/40 portfolio have been greatly exaggerated. And bonds, specifically traditional, high quality, liquid fixed interest securities, are probably as attractive now as they have been at any point in the last decade, especially in an environment where income across other asset classes, such as dividend yields on equities and bank hybrids, are becoming more challenged. So I might start with the first slide and maybe the elephant in the room. And that is the role of traditional duration as a portfolio diversifier, because that has come under a lot of scrutiny of late. And many would bring up the rising correlation between the returns on equities and the returns on fixed rate bonds. But I'll just point out that this correlation is, not constant over time. It does vary, and it varies largely with the inflation regime. In much of the 2000s, the correlation was negative as growth was the main, cause of macro shocks. But more recently, we've seen the correlation rise as inflation, rather than growth, has been the main concern for policymakers as well as multi-asset portfolios. So the question, isn't whether, the correlations are stable. Well, they're not. Correlations have risen. It's really about whether you're getting paid for it. And I'd argue bonds are offering pretty good compensation, even in an environment where inflation might remain problematic for a little bit longer. And just moving on to the next slide. To unpack this, we have to explore this idea of term premium. So we've seen that correlations have been rising. So on the surface, the diversification benefits of bonds, at least in recent history, have fallen. But there has been compensation, I'd argue, in the form of higher nominal yields and higher real yields. So we see right now that 10-year yields in Australia have been settling around 5% in nominal terms, while in the United States, Treasury yields have, recently returned to above 4.5%. But on the second chart in the lower panel, we see that inflation-adjusted yields or real yields. So these are the yields that you earn on inflation-linked sovereign bonds are very much at their highest levels in the past decade or longer. And in the case of Australian and US sovereign inflation-linked bonds, you're looking at some of the highest yields in the post-GFC period in inflation-adjusted terms. And just to be clear, inflation-linked bonds have their coupon and principal payments indexed to CPI, whether that's Australian CPI or US CPI. So you are, effectively able to lock in a CPI plus return. And right now, that return you're able to lock in, is very much, well above what inflation will realize over that time horizon that's equivalent to the maturity of the bond in question. But I guess that's the key point. Many multi-asset portfolios do have, let's say, CPI plus benchmarks or CPI plus objectives, and inflation-linked bonds are really the only true CPI plus building blocks. And right now, real yields are quite compelling. So you can go a long way to hitting your real return targets from even government bonds, provided you do have the ability to withstand some short-term volatility, which in our view will likely remain elevated for some time, just as inflation pressures remain problematic. Now, there are some other measures of term premium that we also look at, not shown here, but the yield curve provides a lot of information, not just around what you can get on bonds today, but also what's priced in for the future. So not only do we have elevated yield curves or elevated 10-year yields, but we do have upward sloping yield curves. So we've seen quite a big sell-off in very long-term government bonds of late, such as 30-year yields across the world have moved higher. And the information contained in the yield curves basically show very high implied forward yields in Australia and other markets. So in Australia, the market is pricing a 5-year yield in 5 years' time of around 5.5% and a 10-year yield in 10 years' time of close to 6%. So it's coming back to my earlier point, correlations are higher, inflation remains problematic, and inflation is still the dominant concern for investors in multi-asset portfolios. But there's a good argument that you are now being compensated for that greater risk. Just on the next slide. So Australian bonds right now, in our view, are also offering pretty compelling relative value. So I mentioned that the 10-year yield is, it's been stabilizing around 5%, and that's a level that our benchmark domestic fixed interest index has also been trading around recently, and that's trading at an elevated spread above the global benchmark, the Bloomberg Global Aggregate Index. Now, that widening spread that we've seen, especially over the past 12 months, is really a function of the RBA being ahead of the curve in terms of this global hiking cycle. And now we're starting to see many other central banks starting to guide towards hikes. So we do expect some kind of catch up. So perhaps the worst is over in terms of the bond sell-off for Australia, just because we were the first to really reprice away from an easing cycle into a new hiking cycle. So we do see relative value in getting your fixed rate exposure or your duration exposure from Australian dollars. But also we do see relative value in AUD credit as well. Australian dollar credit spreads on a like-for-like basis are also trading at a bit of a premium or an elevated spread compared to US dollar alternatives. So for that reason, we do prefer Australian bonds overall versus global bonds. Just on the next slide. And just on Australian bonds, I'll just highlight that our bond market is really coming of age, and the Australian credit market in particular is really having a bit of a moment. So in 2025, by some measures, our corporate bond market and our credit market more generally was number 3 in the world for primary market activity. So that's new issuance, just behind the US dollar and the euro market, but ahead of the sterling and Japanese yen market. And as a result, we're seeing our market become much deeper. We're seeing more longer tenors of new issuance. So we're seeing a lot of new issuance come in that 7 to 10-year part of the curve. And we're also seeing a lot of inaugural issuers, both domestically and foreign via the so-called kangaroo market. And also, Australian bonds are very much on the radar of the largest global savings pools in the world. So the big pension funds and sovereign wealth funds are also looking at our bond market and taking a very keen interest, just given the attractive outright yields and relatively attractive credit spreads on offer in Australian dollars. And we also do have a lot of things going for our bond market. So even on the sovereign side, some fiscal concerns notwithstanding, at least on a relative basis, our public finances appear pretty good, at least compared to, say, the United States, the UK, Japan, some other developed markets. Australian sovereign debt remains one of the few deep liquid markets that still carry a AAA credit rating, as well as our financial system is seen as very strong, underpinned by our big 4 banks. So there's a lot of things going for our credit market, and that's the reason that many global investors are turning to it. But on the flip side, a lot of big global issuers are also looking at our credit market a bit closer right now. So as many in the audience would be aware, there is a bit of an AI capex boom going on, and we're starting to see much of that being financed now via the debt market. So we are seeing a surge in corporate bond issuance from the hyperscalers. Much of that is primarily in the US dollar market, but they have been diversifying their funding sources to other currencies like Swiss francs, pound sterling, Japanese yen, Canadian dollars. So we do think, just given the maturing and the coming of age of the Australian credit market, the hyperscalers will turn their attention to AUD pretty soon. And in our view, those new issues, those deals, when they come to market, they will be very well received because many, I would say, most local credit portfolios are very much underweight technology debt. Technology is a very small part of our credit benchmarks and our broader fixed interest benchmarks. So it would provide, maybe much needed diversification for local credit portfolios. But with that, I might, hand it over to Khurram and Tristan.
Thank you, Chamath. That was insightful. If I can summarize, the story here is that bond market is going through a structural reset. Inflation has changed diversification dynamics. Yields are now more attractive. Relative value is emerging across regions like Australia. And even thematic forces like AI are starting to influence credit markets. With that, I'll now hand it over to Tristan Bowman, partner at Cameron Harrison, for his presentation.
Thanks, Khurram, and thank you for hosting today. So just to recap a couple of the macro themes that we've had spoken about both today and on Monday and Tuesday. We just move to the next slide. Thanks, Toby. So there's a few things that we're thinking about in terms of fixed income and how we're positioning portfolios. So firstly, the complex macro backdrop. Rate cutting cycles have stalled, inflation's reaccelerating, bond yields and term premiums are now higher. Domestically, the inflation trajectory was difficult for the RBA before the Iran conflict. That's only adding fuel to the inflation fire, but possibly at the cost of consumer spending. In the US, we're now seeing market forecasts no longer pricing in rate cuts. The FOMC still thinks there may be cuts to come in this cycle. In Australia, rate cuts are obviously off the table. The question is how many more rate hikes do we have from here? The third theme, which I think is probably a more longer-term feature of the Australian market, is structurally higher inflation driven by two things. Demographics are changing. The baby boomer demographic is no longer the largest portion of the population. That is now the millennial demographic. The push down in interest rates through the higher savings mechanisms through the baby boomer generation, that is beginning to dissipate at the same time that we're seeing structurally higher government spending moving to 26.5% of GDP from the norm of 24%. We're also seeing deglobalisation having an impact on supply chains and free trade agreements as well. As Chamath mentioned, diversification and the correlations between bonds and equities does depend on the regime that we're in. And the question that we have is, do higher starting nominal and real yields mean a negative bond equity correlation returns? The important thing for all of this in terms of the fixed income context is that higher yields means that fixed income is a relevant asset class again. 5 years ago, when we had the RBA rate at 0.1%, we had senior bank debt trading at 25 basis points over swap. It wasn't a very compelling story to invest in the fixed income asset class. So the next question that we ask ourselves is, how do we prosecute that opportunity there? On the next slide, we've got a couple of things to think about in terms of the challenges that we're facing in the fixed income asset class, and then the approach and how to address that. So the first thing is that inflation-driven volatility does make the equity bond correlation unstable. How we think about addressing this from a multi-asset class lens is to separate out your interest rate and your credit duration exposures within your fixed income asset class. Separating those out and also considering your total interest rate duration from an overall portfolio perspective in terms of multi-asset class, we think is very important in this environment. The second challenge is when rates rise sharply, duration impacts bonds, growth equities, property and infrastructure equally. Our preference at the moment is to prioritise floating rate securities in portfolios where there are significant property growth, equity infrastructure holdings. In the same way that you would consider an asset allocation as a spectrum, we also consider fixed income from an overall risk return spectrum perspective as well. The point of that is to say that you need to actively manage those fixed income positions to reflect the macro conditions. There are going to be flow-on effects from the oil shock. They are uncertain. Business and consumer confidence seem to be weakening, particularly consumer confidence. The portfolio positioning approach in that environment, we would suggest, is prioritising quality investment grade over high yield. The last point is genuine protection against inflation. And that's something that fixed income is not generally known for in terms of quality. But as Chamath mentioned, inflation-linked bonds at the 10-year level with a real yield of 2.5%. At the 25-year maturity, a real yield of close to 3%, are much more attractive than they have been over the past 20 years, really post GFC. They are theoretically right, but practically constrained. So inflation-linked bonds can solve a problem for investors, but that problem is generally pretty specific. It's unlikely to be a good fit for all investors, but they do offer genuine inflation protection over time at the cost of nominal cash flows and with long duration exposure typically. When we think about active management, on the next slide, we've got a summary as to overall credit stack exposures over time. And we look at this from a relative risk and return perspective to make sure that we're tilting the strategy towards the asset or the sub-asset class that we think exhibits the best risk-reward trade-off. So underpinning this is active management. In 2016, we had a very large exposure to hybrids at a time where We were seeing macro issues in China flowing through to Australian credit markets, and hybrids were trading around 500 basis points over swap. I think we had the Westpac Capital Notes 4 issued in 2016 at a 4.9% margin over swaps. It's hard to wrap your head around now with hybrids trading at the low 200s. At the end of COVID, we had very high senior debt allocation through 2022 and 2023. We had the opportunity to rotate out of Tier 1 hybrids and into Tier 2 subordinated debt in a really odd point in the market where Tier 2 margins were trading wider than Tier 1 despite being higher up in the capital stack. Fast forward to 2026, a lot of fixed income sub-asset classes look expensive to historical averages. The slight exception to that rule being senior debt being only slightly below the long-term averages. I think both Chamath and Cameron mentioned this on Monday. Credit spreads in Australia do look better than our global counterparts. And in an environment where we have a very strong banking system, the Australian credit market is very attractive to offshore investors, in particular investment-grade fixed income here, but also private credit assets as well. The point here is pretty simple. Actively managing sector and security positions can help smooth out your returns and also help position your portfolio best on a risk-reward perspective. So then we think about it from the overall purpose of fixed income. On the next slide, we've got a couple of key questions that we ask ourselves when we're managing fixed income portfolios for clients or for mandates. The first question is, what are you trying to achieve here? Fixed income can offer a lot of different diversification benefits, but you need to understand what you're trying to achieve out of it before you build your portfolio. Is it purely diversification away from equities and other asset classes? Is it income enhancement? Is it maximising income by going up the risk curve to high yield or private credit? Is it a store of liquidity, or is it purely for defensive positioning? That then guides the second consideration in terms of risk appetite and the types of risks that you're willing to take on and the types of risks that you're trying to protect against. Then we get into the specifics of portfolio construction and how fixed income integrates to a total portfolio. So looking at investment horizon, overall risk profile, and total portfolio duration then may well guide you as to how you offset other duration exposures with perhaps a low duration fixed income strategy. On the next slide, we've got a few questions in terms of client considerations and then how to adjust as a portfolio for a particular client. So one of the factors we look at is investment horizon here. So the shorter the investment horizon, the shorter the portfolio should be in terms of interest rate duration. If a client has a 2-year investment horizon, there's no point investing in 10-year government bonds. You've got to effectively match the asset to the liability. The second point is risk appetite. In the same way that we think about this from an asset allocation perspective, we've got to look at it from a fixed income perspective as well. When we think about that, we look at credit duration and the mix between investment grade and high yield or credit or private credit. Income and liquidity needs, generally there's a bit of a trade-off there. We then look at the sub-asset class exposures, the tenor of the assets, and the type of assets that you're investing in. So a client with a lower income but a higher liquidity need, we'll generally say you should be investing in very liquid major bank senior debt paper, for example. But if you're looking to enhance the income, well, then you may well go higher up the credit curve. And then longevity and inflation protection. So as I mentioned earlier, this is for a really specific set of circumstances here. But floating rate notes in terms of inflation protection, at least in terms of the income that you're getting, and then inflation-linked bonds in terms of protecting capital there. The overarching theme about all of this is that fixed income is not a one-size-fits-all approach. Client considerations really underpin that bespoke portfolio management, and you will need to tie the fixed income exposures to the particular client or organisational needs. So that's what we think about when we're looking at constructing portfolios. I'll hand back to you, Khurram, to go through, I think, a few Q&A questions.
Thank you, Tristan. So if I can summarize the message, is that inflation and volatility have disrupted traditional diversification. So fixed income can no longer be treated as a single passive exposure. Instead, it requires a more active, tailored approach, separating rate and credit risks and aligning the portfolio with specific objectives. With that, we now move to our Q&A session, and I will actually stay with you, Tristan. Now, in your pack, you highlighted that diversification has become less reliable, particularly with inflation driving more unstable correlations. Based on that, how should we think about diversification in fixed income today? And where are you actually finding it across duration, credit, sectors, and regions?
Yeah. So as I mentioned, we think about it like any broad multi-asset class asset allocation setting. So diversification really means different risk exposures and the drivers of return. So in fixed income, the key question is principally fixed v floating rate exposure at the headline level, but then also diversified credit exposures in terms of credit ratings all the way from AAA to BBB minus or sub-investment grade. We look at issuer types, we look at security types, senior subordinated hybrid, RMBS, ABS, secured, unsecured, covered, term deposit. There's a lot of different security classes there. And for us, we're making assessments on where we think the relative value is for a given level of risk. For our core interest income strategy, on average, it's an A- rated strategy. We look to deliver a 2% margin over risk-free rates. We have lower risk credit strategies, and we have higher risk, more private credit strategies as well. Typically for a client, you are looking to diversify those risk exposures predominantly. What is your downside? What is your exposure to, let's say, hybrid securities if there's a change in regulation? What is your exposure to a particular bank or a particular corporate or a particular organisation? And what's the downside risk there? What's the probability of default, and what's the likelihood of recovery? So for us, we're not here to take excessive oversized positions in one security or one entity. The portfolio may well have 60 different positions across a number of asset classes or sub-asset classes in the fixed income world. And then we're just looking at where we think relative value lies there.
Thank you. And Chamath, I'll be keen to get your take on this as well.
Yeah, so I think everything that Tristan said is correct. A lot of it really depends on, I guess, your needs and what you want to get out of fixed income. Tristan used the term, not one size fits all, and that is 100% accurate. Fixed income is a broad church. It delivers many different return outcomes. Floating rate can behave very differently from duration exposures, and even within fixed rate exposures, investment grade can behave very differently to high yield, depending on where you are in the cycle. I will just say that it is important, though, that for a well-diversified portfolio to have some kind of protection or some kind of ballast in all economic environments. Right now, probably the balance of risks does skew towards inflation, but I would argue that a lot of that is expected, and it's probably been reflected in this narrative around the death of the 60/40. It very much is close to a consensus view that inflation risks are going to be probably elevated, at least compared to the 2000s and the 2010s. But that being said, the risks of, let's say, a growth scare have not disappeared. I still believe that there is a business cycle, and as a result, there probably still is, risks of a recession, whether in the US or here, at least sometime within our long-term investment horizons. So with that in mind, there is always, a reason to have a little bit of fixed rate bond exposure, provided that your liquidity horizon supports it, just to protect you from that kind of outcome, which right now is very much not priced in or expected. And there are, very few asset classes that provide you that kind of diversification benefit in an acute growth shock or a recessionary type environment as high quality fixed rate government bonds.
Thanks, Chamath. Then I think staying with you, you did mention that the inflation regime has changed the relationship between equities and bonds. So what has really changed in practice? And you brought up the 60/40. So how should investors think about that 60/40 going forward?
Yeah, so and I think it's closely tied to this idea of term premium, and I touched on it in my pack, and Tristan also touched on it. But just to unpack it a little bit further, term premium is the additional compensation you get from taking on interest rate risk and inflation risk by holding a long-term fixed rate bond compared to, let's say, rolling short-term securities or holding cash over that same time horizon. So it's that additional yield to compensate you for, mark-to-market volatility and inflation risk. The term premium can go a long way to offsetting maybe the reduced traditional diversification benefits. So, the correlation might stay elevated for longer, as inflation, might continue to be a bigger source of angst compared to growth. But, there is now more compensation for that. So if we cast our minds back to the 2010s when bond yields were low and measures of term premium were also low, investors were happy to accept that because, bonds had a negative correlation to equities. So the typical risk off move coincided with a flight to quality in fixed rate bonds, especially government bonds. So even though you're giving up something in the way of expected return from fixed income, you are getting a benefit in terms of the overall reduction in portfolio volatility. Now you probably are not getting the same reduction in volatility as you were getting before, but you are getting maybe a higher uplift in terms of expected return from your defensive sleeve, and you're definitely getting an uplift in income. And that is, maybe a point that shouldn't be understated. During the previous regime, when correlations were negative, high quality government bonds were not really a compelling source of income. Whereas right now, with yields at 5% and even just moving slightly lower down in terms of the credit spectrum, moving to state government bonds, government related securities, the big four banks and high quality investment grade corporates, you're earning between 5.5% and 6%, on intermediate term liquid investment grade bonds. So, and that's a pretty compelling source of income, especially when the dividend yield on the ASX 200 is, below 4%. And as Tristan mentioned, hybrid yields hybrid spreads are not as compelling as they once were, and that market is, being phased out.
Thanks, Chamath. And Tristan, I'd be interested in whether you see it the same way or if your approach differs.
I think we say it very similarly to Chamath. I think the starting point is obviously very different now. So we've got 10-year government bonds at 5.1% compared to 0.8% in 2021. So there is already a lot of inbuilt protection there. But again, I'd like to echo what Cham said. If you are willing to sustain or withstand the additional volatility that you will get from fixed rate bonds over that holding period. So if you've got a 10-year investment horizon, 10-year government bonds, I think are attractive at this point in the cycle.
Yeah, and Khurram, I might just add to that. The initial conditions do matter a lot, and I do think some of these elevated yields and elevated volatility is maybe a little bit of lingering scar tissue from what we saw in 2022. But we saw a historic repricing then on the back of it was almost a combined supply and demand shock with the effects of the COVID reopening and a lot of the fiscal stimulus still working its way through to the economy at a starting point where policy rates were still at ultra accommodative levels and bond yields were at historical lows. It is a very different set of initial conditions today. We met with another supply shock, but the demand side is maybe a little bit more challenged. We're not having the same kind of fiscal stimulus we're seeing today compared to 2022. And obviously, the RBA cash rate is somewhere between neutral and restrictive. And the 10-year yield is obviously 400 basis points higher than it was 5 years ago.
Thank you. I think that's very, very insightful. Tristan, turning gear here, let's talk about the inflation-linked bonds and their roles and constraints. So in your pack, you pointed out that inflation-linked bonds are theoretically the right solution, but practically constrained. So based on that, what role do they actually play in the portfolio today? And how do you weigh that up against things like liquidity, market depth, trading cost considerations, etc.?
Yeah, so I think as we've spoken about, the real yields are the highest they've been since the GFC. I think inflation-linked bonds serve a role in a portfolio if you have an expected liability that lines up with a maturity of a bond, or you have cash flows that line up over the duration of that bond. I think they work better for wholesale investors than they do retail investors, given you're paying buy-sell spread on entry and exit if you're buying these securities on the ASX. I think in the context of the inflation-linked bonds that are on the market today, you need to be comfortable that you are trading away cash flow now for cash flows a long way into the future. So the bonds that are trading on the market now have been issued when real yields have been very low. There was a bond that was issued in 2021 with a 0.25% coupon. So the actual cash flows that you're getting from that inflation-linked bond are very, very low. So there are three components to an inflation-linked bond return. It's the cash flows from the coupon. It's the pull to par over time if it's trading at a discount. And then it's the CPI indexation over time. So it's quite a rare set of circumstances where an investor is willing to trade away the cash flows now for pure inflation protection into the future. But I think they are worth considering at the very least. The problem that we have in Australia is that inflation-linked bond issuance by the government has been very sparse. So if you're looking at a roughly 10+ year maturity, you're looking at 2035, 2040, 2050 maturity bonds. Compared to if we were sitting here in the US, you'd have a set of inflation-linked bonds issued every year. So it does make it hard in Australia from an overall portfolio perspective, trying to match those liabilities and cash flows. But if you're particularly worried about structurally higher inflation being well above what break-evens are at today, and you're willing to trade off lower cash flows, then I think there's an argument to make for them.
Thank you. And Chamath, same question to you.
Yeah, I think linkers, ILBs, inflation-linked bonds are a very interesting space, especially right now. But again, sometimes the implementation can be challenging. Tristan made the point that, perhaps they're more of an institutional product or an institutional asset. I will also add, though, that liquidity, even in the market for Commonwealth government index bonds, are significantly more challenged than the nominal equivalents. So many of the largest institutions, are quite attracted to this market, but they worry about their footprint and the slippage from actually trading it. So there is possibly a role for wholesale investors or investors that do have the sophistication but don't necessarily have the size to move the market around, where it can be quite compelling. I think one thing that's often understated, and this is something that Tristan did touch on, is the amount of interest rate risk that's embedded in ILBs. So the standard, government inflation-linked index, the Bloomberg version of that index, has a effective real rate duration of around 7.2 years, and it was significantly higher in 2021. So a lot of people holding inflation-linked bonds, especially when real yields were negative as a starting point, with a real duration at the time of 8 to 9 years. So pretty significant mark-to-market losses, despite inflation being at its highest level in 3 decades. So, what you made on the CPI indexation was more than offset by the actual mark-to-market losses. And typically, you do get more compelling real yields the further out the curve. So short-dated linkers, right now, the real yields are probably not that compelling because short-term inflation expectations, both through inflation, through the inflation swap market, but also implied through break-evens, are quite high for shorter tenors. Whereas the longer tenors, they're normalizing, or they're anchored around 2.5%. So you do get compensated for taking on a little bit more interest rate risk right now in the linker market. So it probably does require a little bit of education because they are quite technical instruments in terms of how they work. But we do think that the environment for them is probably as good as it's been in a very long time. So it's definitely worth a consideration, and it's worth more investigation for any investor that is looking for some kind of CPI plus building block.
Thank you. Thank you for
I think the complexity is a really good point. That you need to educate the investor as to what they are and how they will perform in different economic and market environments.
Appreciate that point. Now let's move beyond bonds. Sticking with the inflation protection. Now, Chamath, in your pack, you highlighted the limitations of relying solely on bonds for diversification in a rising inflation environment. So, where should investors be looking beyond traditional bonds for inflation protection, and how do you size those exposures alongside fixed income?
It's a really good question because it's worth unpacking the nature of inflation risk for portfolios, because there's quite a few dimensions to it. There's obviously the inflation risk associated with realized inflation. There's also the inflation risk associated with higher inflation expectations. And depending on what is a greater risk for your portfolios, it demands, might require a different asset class. Inflation-linked bonds, for example, when they're part of your fixed income allocation, they are a good way of delivering, let's say, excess returns versus a nominal bond benchmark in an environment of higher inflation expectations, or an environment where inflation is realizing above what was priced in to inflation break-evens over an extended period of time. But for hedging the risk of, let's say, near-term inflation shocks, such as what we saw at the start of March, or in February of 2022, it's often commodities that are probably maybe a more effective hedge for a true unexpected supply shock. They tend to be, maybe the shortest duration asset class around, because they reflect, the physical supply and demand in the real economy. And I guess at least recent, inflationary shocks have maybe supported at least giving commodities or commodity centered equity exposures a bit of thought. And, I have noted that, let's say, energy stocks, energy companies, they are, a fairly low weight in global equity benchmarks, but they have been, offering a pretty compelling diversification case compared to, say, headline equity indices or fixed income. They have seen, they have been offering pretty compelling diversification benefits. So you have a few options outside of traditional bonds. You've got, obviously, real assets. You've got gold, although, gold itself has been a little bit of a wild card of late. But there's also commodities and commodity focused equities as well.
That's helpful. Tristan, anything you'd like to add or take a different view?
I think the overarching point is that inflation is a very, unexpected outbreaks in inflation are very hard to protect against, and it will depend on what the driver of that inflation outbreak is. So I think the last two scenarios we've had have both been commodity driven, and therefore the protection has been in those commodity, either holding the commodity itself or equities that are in those industries. But it is very difficult. So I don't think I have anything great to add on top of Chamath's comments.
Oh, that's great. Thank you. Look, let's talk about risk management now, especially when the playbook breaks. So, Tristan, staying with you, you've talked about the need for active management exposures to respond to a more volatile and uncertain rates environment. So, based on that, what stress scenarios are you focusing on today, and what are the key risk management lessons you are applying? And I think if I can just add one more to that, what scenarios do you think investors are not testing for today?
Yeah. Again, I think you look at what is going to drive your return both in the positive and in the negative. And principally for fixed income, that's going to be interest rate duration and then spread duration as well. So there are a couple of scenarios that people are thinking about now. One is stagflation. We have high inflation and very low growth. That's a very difficult environment for multi-asset class portfolios. Short dated floating rate bonds will give you a hedge, at least in terms of higher interest rates flowing through to higher income. But over the long term, that's a pretty bad environment for wealth creation, really. The other one, which Chamath touched on before, is where we have an environment that the oil shock may extend for longer than what people are thinking. I think people are wrapping their heads around that now. And then you have a demand shock, which then flows through to lower growth and possible recession. So, in that, it is in that environment where your fixed rate exposures should perform quite well, but you will have a widening in credit spreads. So, in that environment, stay short in terms of your credit exposures, stay add a little bit more duration, but try to keep it very low risk duration. So, either government or semi-government bonds in that environment. So, in terms of the question that we spoke about before in terms of diversification, you want a portfolio that will have at least some positive performers in any environment that you model out. So, we try to think about it both from an equity perspective, trying to blend that with the fixed income exposures so that let's say in an oil shock, a higher oil price for longer oil shock, you do have some oil producers in the portfolio subject to ESG constraints that will benefit from that. And then you have some liquidity in the portfolio to be able to move positions if and when you need, if you saw that you were able to take opportunities elsewhere. I think that's really the key thing. Liquidity is key in any crisis.
Chamath, anything to add to that?
Yeah, I think one thing that shouldn't be understated for fixed income is the mean reverting nature of the asset class. And it's really mean reverting through two channels. The first is obviously higher starting yields mean higher future expected returns. And higher starting yields are obviously, maybe a product of, weaker performance recently. But the other mean reverting channel for fixed income is higher starting yields. If they're coming on the back of a policy tightening cycle, that also tightens financial conditions more broadly, which will effectively weigh or eventually weigh on growth assets. Because if you think about, why central banks are raising rates, it's to tighten policy, tighten financial conditions, to eventually bring supply and demand back into alignment. So there is a point in a rate cycle where it does become a real headwind for, let's say, other asset classes, such as credit, especially the lower quality segments, but also equities. And I'll also just, echo the point about liquidity. Liquidity is important because especially if you're, let's say, running a more dynamic asset allocation model, liquidity provides you the ability to redeploy and express, tactical flexibility, which can be very important. So it's important that your defensive assets are not locked up in order for you to deploy them into, let's say, risk assets at the appropriate time if the opportunity presents itself.
On that note, thank you, Chamath and Tristan. We had several other questions, but unfortunately, we've run out of time. I'll now pass it back to Toby for his final closing comments.
Khurram, Chamath, and Tristan, thank you very much for your time. I found it fascinating. I did want to touch on a couple of points myself that came up. Chamath, I might start with you. You mentioned the 10-year forwards projecting a 6% yield. So I take it from that what the market is telling us is this level of rate is expected to persist for quite some time. That's a decade.
Yeah. So and it comes down to this idea of this term premium. So what's priced in is not necessarily what's truly expected. What's priced in is often reflecting the compensation that investors are demanding. And one of the great things about the yield curve is that there's so much information contained, not just about the present, but about what's priced in for the future. And the way you can think about a 10-year forward yield, it reflects the information that's contained in the current 10-year yield and the current 20-year yield. So it's reflecting not just the yields themselves, but also the shape of the yield curve. And we've seen a big repricing in that forward yield across the world, especially in recent weeks.
Yeah. And Tristan, you talked about the spread of investments that you'd expect your clients to have to manage a portfolio of the sort you were talking about. I think you talked about 60 different instruments within the portfolio. So do I take it from that for your clients, typically they're getting their fixed rate exposure through direct bonds, direct holdings, rather than through the sort of pooled vehicles?
Yeah, correct. And it'll depend on whether you're wholesale or whether you're retail as to whether you can prosecute that. I think we're in an unfortunate environment where listed debt markets in Australia are dying a slow death in terms of the direct exposures that you can have. But I think it has been for retail investors, it has been a good thing seeing the rise of more stylized ETF exposures. So, you could take subordinated debt, senior debt floating, fixed corporate, and then you can prosecute that strategy through ETFs or managed funds. I think, really the reality is for retail investors, listed markets are nowhere near what they were, 13, 14 years ago.
Yeah, we didn't prepare that earlier, but music to Cham's ears. So, Chamath, Tristan, Khurram, thank you very much for your time. Let me just remind those of you who are with us of IMAP's upcoming events for the rest of the year, the major events, the Advice and Action Conference, Alternative Week in September, Independent Thought, and our MDA Symposium, plus the workshops and other webinars that we'll be running this year. So thank you very much for joining us, and we look forward to you joining us again in the future. Thank you very much.